Hello and welcome to this podcast from the Private Wealth team at Saffery's. My name is Leonora Stevens and I'm a partner in the Private Wealth team based in Bristol. I'm joined virtually by Mike Hodges, a fellow Private Wealth partner based in our Manchester office. Hello, Mike.
Hi, Leo.
Today, we are very lucky to have a returning guest. Not once, twice, three times, but the fourth time, we have Alex Britton-Davis, a tax partner in our London office, who's a specialist in advising on UK residency and domicile matters. Welcome, Alex.
Thanks for having me, Leo.
So, to continue with our sort of recent themes, we are going to be discussing another topic that was covered in Rachel Reeves' autumn budget. Although some of the ideas that we will discuss were actually initially raised by Jeremy Hunt in a policy paper back in March 24, and then Rachel Reeves gave more detail and the actual legislation came out in the budget. So this topic will be in relation to the changes to the non-dom regime. As usual in our podcast, some of our topics are highly complex, and I can say that the full details are on our website. However, today we're hoping to provide listeners with a short summary of the changes and the key implications for non-doms and what clients should be thinking about, in particular before the end of the current tax year, plus a few examples of what clients are doing now in relation to the changes. So Alex, would you like to summarise the key issues and perhaps start with what the old rules are and why it's of relevance?
Yes, of course. So the current rules that we have are what's known as the remittance basis. And this is sort of a very, very long held policy over 100 years that's gone through various changes. But broadly what it means and what it's always meant is individuals who are not UK domiciled can elect to be taxed on a basis whereby only their UK source income and gains are taxed and their foreign income and gains are untaxed unless they bring it to the UK. So they remit it to the UK, hence remittance basis. So currently that basis can apply for up to 15 tax years of residence, after which you will be taxed on a worldwide basis. That is changing. So the first key change is it no longer looks at domicile. We only look at residence. So anyone who has been non-resident for a period of at least 10 tax years can claim this new, what we call foreign income and gains regime or FIG regime in their first 4 tax years of residence. And unlike the remittance basis, once you make this claim, your foreign income and gains are just not taxable, full stop. You can bring them to the UK, spend them here, invest them here, and you won't pay tax. So the good news is you don't have to worry about keeping those funds offshore. The bad news is you only get the regime for 4 years instead of 15. So there's some pluses, some minuses.
What about individuals? So if we've got someone who we are recording this in sort of January 25, so in the 24-25 tax year, if coming up to the end of this tax year, they would have been UK resident for 4 tax years, what will happen therefore on the 6th of April?
Yeah, so for individuals who are already here, the test will be the exact same. So did you have, firstly, before becoming UK resident, 10 full tax years of non-residence? And if so, are you in your first 4 tax years of residence? So if the answer is yes, maybe you moved to the UK in the current tax year. So this is your first year, you'll have 3 more years in your first 4 years. So you can claim this new FIG regime for 4 years. If you've already been here 4 years, this is your 4th year or your 5th, 6th, 7th, then from the 6th of April 2025, you'll be taxed on a worldwide basis. So the exact same test applies and you just have to look at how long you've already been here.
So for those people, Alex, that's a really dramatic change, isn't it? You've gone, as you described, you've gone from the existing regime to suddenly a 4-year cutoff. So someone who's been here 5 years, wow. And it's from this April.
Yeah, exactly. So someone might have thought they had another 10 years, maybe their children are in school and they had a plan. They can't immediately leave the UK. They've set up a business here, they've got a job here, etc. So that's going to be a really big change and, as you say, quite a short time period.
Sorry, we were talking about some of the other changes and we've got some not until next April, and then the pension change is April 27, but this one's crikey, quite, weeks away, isn't it?
Yeah, exactly. And as Leo said, Jeremy Hunt first sort of announced this policy formally at his last budget back in March. That was would have been 13 months before the changes were coming into effect. And obviously with the election left a lot of uncertainty. So it really is quite a short time frame for what are very, very significant changes. As I said, the remittance bases have been around for a very long time. So these are really quite seismic changes for those people.
Yeah.
If you've got people where they're about to come to the end of their 4-year window, and so they'll be taxed on a worldwide basis from the 6th of April 25, is there anything that you think, would you recommend that they sort of start thinking about now? What should they put in place to mitigate their exposure?
Yeah, absolutely. So I think the key thing is people will be in really different circumstances. So you really do have to look at your position, what types of income and gains you have, and therefore what might work for you. But some of the general things we're seeing are, can you make any gains in income arise this tax year rather than next? If you can claim the remittance basis this tax year and you can't get relief on that income and gains next tax year, could you sell any assets that are sitting at a significant gain to rebase those? If you've got, say, a non-UK company that you're due to receive a dividend from, make sure that that's paid before the 5th of April, something like that. If you're going to draw down on a foreign pension, something like that, that you can actually claim the remittance basis on. With things like realizing capital gains, you need to be very careful of what we call the bed and breakfasting rules, whereby if you repurchase assets within 30 days, that acquisition is matched with your sale. So essentially you don't realize a capital gain. But yeah, there's certainly things that people could be looking to do this tax year whilst they can still claim the remittance basis.
And time is ticking, isn't it, really? I mean, it will be upon us before they know it. So, yeah, so I think people, the tip would be make sure you speak to your tax advisors and also your investment managers, because obviously we don't give investment advice, but for a longer term perspective, it's a benefit. We can advise on the tax perspective. And then historically, the remittance basis was always something that was claimed by non-doms, but with the new changes coming into effect, and it's now really based on residents, how do you think that this will sort of impact the UK DOMs who might have gone to live overseas for sort of 10, 15 years?
Yeah, I mean, absolutely. The winners of these changes are those UK DOMs who have lived outside the UK for a significant period. So, it's not unusual for someone to take a job elsewhere, work there for in excess of 10 years. And those individuals, perhaps they're coming back to the UK on retirement, perhaps they're just moving here to settle down with a family, but they might be able to really take advantage of those 4 years where their foreign income and gains aren't taxable. And we won't go into detail on this now, but actually the inheritance tax changes also are switching to a residence-based test, whereby if you leave the UK and you're non-resident for 10 full tax years, you're outside the scope of inheritance tax on your worldwide assets. UK assets always taxable. And so those individuals who have non-dom retired abroad, but perhaps, still have connections to the UK, they now get certainty that of what their inheritance tax position will be. So yes, as I say, the UK DOMs really are the winners in this. And what that gives those individuals is real certainty. The residence test is straightforward. We have a statutory residence test. You can check whether you've been resident for 10 full tax years or not. So there is sort of certainty around that. And as I say, the UK DOMs are the real winners in this.
The whole domicile concept is one that's really painful to try to explain to a client, isn't it? You could say, well, you've been out of the UK for years or decades, but you might still be UK domiciled. It all depends, and HMRC will no longer give you a ruling. So it always felt like you were fighting an uphill battle in trying to explain the whole concept to a client. So as you say, much simpler now.
Yeah, exactly. I think, and that's one of the things that both Jeremy Hunt and Rachel Reeves did say, is they want a simpler system. Domicile is a complex system. It's a bit outdated. It's based on your father's domicile, not your mother's domicile. It doesn't work if your parents are a same-sex couple. It simply just doesn't give you an answer. And so it really was time to have a change. So the move away from domicile, I think, is a very positive one to give people that certainty and remove some of the complexity.
I was thinking of all those people who have spent hours on writing domicile statements that have to be filed along with their will to make sure that the intention was clearly stated at the time that they did not intend to die here or live out the rest of their life here, and they always intended to move overseas. Also, I suppose, from the FIG regime, as you say, I think it hopefully will provide greater clarity and simplification. But from a practical perspective, How do they claim the relief? Do they need to pay for the relief? And what do they need to think about for their tax returns in the UK?
Yeah, so unlike the remittance basis, there's no charge for claiming the relief, but you do lose your personal allowance and capital gains annual exemption. So there's a little bit of a cost there, but obviously if your income and gains are in excess of those amounts, it's still worth claiming. From a practical perspective, it's going to be more complicated to claim than the remittance basis. The remittance basis was tick a box on a tax return, claim the remittance basis, and then you don't need to report your foreign income and gains unless you bring them to the UK. With the new FIG regime, you do need to report all of your foreign income and gains in order to claim the relief. And the relief is only available to the extent that you've claimed it. So if you miss off a source of income and don't report it within the time frame, then that income is taxable. So it's quite sort of complex in that your tax return is going to need to report exactly the same things as it will in year 5, because you have to report everything to make the claim. But also there's a little bit of jeopardy there. You know, if you don't get things right, then suddenly things are taxable. So the time frame for making the claim is the 31st of January after the normal filing deadline. So you do have, what will that be, 22 months to make the claim. So you file your tax return, make the claim, maybe the next year you spot something that was missed off, you still have time to make that amendment. But after that's passed, you probably won't be able to make that claim. And it sort of does add a little bit of jeopardy. And as we know, reporting foreign income and gains isn't always straightforward. Certain sources very easy to calculate, but particularly, for example, if you're invested in a US private equity fund, which reports on an annual basis, not on a tax year basis, that can be quite tricky to work out exactly what to put on your tax return. So I think this will be, people will have more complicated tax returns, will likely need more assistance with those to make sure they're right, to make sure they actually get the relief.
And do you think people are put off by that, just the reporting? Because the ticker box for remittance basis is quite simple. It's all opaque, isn't it? This suddenly, all of your worldwide income gains are being disclosed for HMRC. Now, I'm not saying for any of our clients that's necessarily a good or a bad sign. We're not trying to hide anything from the revenue, but it's this confidentiality concept that is suddenly being swept away, isn't it?
Yeah, exactly. And we did have clients who would claim the remittance basis for an easy life. For example,
Mm.
US taxpayers who were already paying worldwide tax on their income and gains, and the remittance basis didn't really, maybe save them a couple of percent on certain sources, but didn't save them a lot of money. But what it did save them was that complexity of having to report everything which they're already reporting in the US on a
Yeah.
calendar year basis in US dollars, converting that all to a UK tax year basis in sterling.
Mm.
It was easier to tick a box. So I absolutely think that we will have people who say, no, it's not worth the hassle. That's too complicated. Certainly compared to the existing regime where people liked it because it was straightforward. The advantage is you don't have to keep everything offshore. So there is an element of simplicity there. There's no segregating your income from your pre-arrival funds, making sure that you know you're bringing the right things in so you don't have a tax charge. That complexity has gone away. But I think some people will just be worried that they'll get the reporting wrong and it will be very costly from a tax perspective.
Mm.
Have you noticed any clients deciding to leave the UK on the basis of the fact that they don't want to declare everything in the UK and from April 25 would be taxed on a worldwide basis?
Yes, we have seen some people leave. It's been a mix. Some people are planning to leave maybe slightly sooner, but won't leave straight away. Some people have already left. Some people are sticking with their plans to be here for the next 10 or so years. And it's been a real mix. I think what we are seeing is everyone doing something. So whether they're leaving, doing some pre-April planning. But yeah, we are seeing some people leave. And I think the greater impact of this change of rules is we'll see fewer people come here, because I think, or we'll see them come, but only for that short 4-year period. The good thing about a 15-year regime is people get quite settled. They may then decide to stay longer. You're more likely to get people putting their kids in school here, spending more money here if they're here for a longer 10, 15 years, whereas 4 years is quite a short period. for people to move their family
Mhm.
and their whole life to another country.
Well, that sort of segues nicely into my next question about for people who have been here for a long time. So where we've got people who initially were on the non-dom basis claiming the remittance and are now deemed domicile for income tax purposes, what are the changes for them? Are there any things they should be looking out for?
Yeah, so we've been given two transitional rules. There were originally three in the Conservative policy, but the Labour got rid of one. So the two transitional rules we have, one is for capital gains tax rebasing, and that rule says if you would have been on the remittance basis, you haven't become deemed dom yet, but you're going to switch to the worldwide basis from the 6th of April 25. You can rebase your foreign assets to their value at April 2017. Now, that's obviously 8 years previous, so it's not a sort of current rebasing like you would get if you actually sold your investments and realized the capital gain. But depending on the asset, depending on how long you've held it, what the value movement has been, that could be quite valuable for some people, particularly for very long held assets that they don't want to sell. Maybe they've got a property that they owned before they came to the UK. That could be valuable. But as I say, you need to look at what is the actual gain at April 17. What's the gain between April 17 and April 25? Do I actually want to sell that and realize the gain, or do I want to rely on that rebasing? So that's one transitional rule which may be helpful for some people, but probably not as helpful as the other one, which is called the temporary repatriation facility. We have pointed out, but it's not a repatriation facility because that would suggest the funds are originally in the UK. And the whole point of this is actually it's if you've got income and gains, foreign income and gains that you claim the remittance basis on previously, you can bring those to the UK at a reduced rate. So it's a 3-year facility. The rate for the first 2 years from April 25 to 2027 is 12%. And then for the third year, it's 15%. And that's really good because the issue with the remittance basis was people couldn't spend their money in the UK. People couldn't invest it here. That's not good for the UK economy. So they've said, we want to encourage people to bring their money here. So they're giving them a temporary reduced rate of 12 to 15%. And so during those years, you can remit those funds, bring them to the UK and pay a lower rate of tax. What you can also do is not bring them to the UK, but designate it. So essentially nominate it as, okay, I'm going to tax these funds, but not bring them yet. And then when you do eventually bring them to the UK, there's no further tax. So that's a really good rule that I think a lot of people will use and will help bring more money to the UK.
Do you think, though, with respect to the reporting, much like people probably thought, oh, if I claim the FIG regime, I can just tick a box and say that I don't have to be taxed on my overseas income and gains. Do you think you'll need to identify the income upon which you are claiming the transitional rules on, the repatriation rules? As in, for example, you could say, well, I received a dividend in 1718 and you can see on my tax return I claim the remittance basis at that point. This is the income I'm bringing in. Or can you just say I'm bringing in income and just tax it as that?
Yeah, so we'll have to wait and see what the tax return looks like. That's always the slight concern, is exactly what reporting are they going to ask for. But the way the legislation's been drafted is there is actually quite a lot of flexibility. So let's say you've got a bank account and there's £200,000 in there, and £100,000 is a dividend and £100,000 was a gift from your mother. That's not taxable. You can say, right, I'm going to remit that 200, pay tax at 12% on the 100, and I can prove that other 100 isn't taxable, so I don't need to pay tax on it. You might also be in the situation where you've got a bank account or you have absolutely no idea what's in there. The way they've drafted the rules is you can just say, I'm just going to say 12% on the whole lot. Not going to bother trying to find out what's in there. It doesn't matter if it's income gain. Maybe some of it isn't taxable. I can't work it out, or I don't want to. It's too hard. And then you could just say, yeah, I'm going to designate the whole lot 12%. So there are those two options, or you could do a mix depending on your different assets. So they have tried to make it a bit easier to say, look, let's just clean this up, make it really easy, so you don't have to do that lengthy exercise of working out what's in an account. If, say, you've got an investment portfolio, you've had it for 15 years, there's going to be a lot of movement on there. So that is a real positive as well, that they've tried to make it a little bit easier for people.
I can see that applying to quite a lot of people, as in, I think the repatriated TRF, as it's known for short, I can see that being a real bonus for those who are long-term residents, and it provides certainty, much like we said with the earlier point, but it simplifies matters, because if we can just do a flat charge on, say, 10 bank accounts, and then they can bring it all here, so it makes sense to me. But are there any other tips or practical steps that clients should be considering if temporary repatriation facility applies to them, or sort of what are you seeing as the trend with clients?
So I think particularly if you're still on the remittance basis, one of the key things with the temporary repatriation facility is obviously it needs to be income and gains you've claimed the remittance basis on. Whereas if you realise that income and gains next year, it's just going to be taxable at normal rates. So it is important to have a look at, what do I need to do this tax year? Do I need to realise some capital gains, realise some income that I can then bring to the UK next year at this reduced rate? Then it might be that you don't need to do anything for a year until we get a tax return, we know what the reporting's looking like, and actually making the claims. But yeah, those are the things that I think is important to look at this tax year. What do I need to do? Do I need to realise that income and gains? And we certainly don't have time to go into this now, but they've also changed the rules around how offshore trusts are taxed, and the temporary repatriation facility can apply to trust income and gains as well. So certainly if you've got an offshore trust, absolutely you need to get advice as soon as possible, because there's certain things you will potentially want to do this tax year before the change in rules in April.
Excellent, thank you.
The job creation scheme for you, really, Alex, for you and the team. It's absolutely nothing to do but for these to be sitting there.
Yes, so we're very busy.
Mike, have you got any other
No, I
tips or comments?
just when we're talking about rebase to 2017, 4 years, all of these, the 12% rate, it all feels very arbitrary. I've said to a number of people, I would have loved to have been a fly on the wall when these decisions were being made, to know what the sort of discussions were, because when you just get you're on the receiving end, it feels like lots of random arbitrary dates and amounts and rates, doesn't it? The other thing, I think, just as a reflection, is that I'm always intrigued by what it will do to people's behavior. So Alex has alluded to that. People are all having to make decisions, whatever those decisions may be. And I guess it's a medium-term play, isn't it, until we know exactly what the bulk of people are doing. Not really for us to comment on it because it starts to get political, but I just find it very, very, very interesting.
It is interesting, yeah. Some of those numbers do. I mean, the 2017 rebasing, 2017 was when they last made significant changes to the remittance basis. Maybe that's the reason they chose that date, but it does seem slightly arbitrary. I mean, certainly we are finding that clients are finding the 12% rate for the TRF very attractive.
Yes.
So there's obviously some balance there of making it low enough that it's attractive, high enough that you do earn a good amount of tax from it. I do suspect, and this is me speculating, not based on any knowledge, I suspect that the reason they want everyone to report their foreign income and gains to make the claim is so that they have a full picture of what relief they're giving under this regime. Under the remittance basis, they had no real idea of what they were doing. They had no idea of what income and gains weren't being taxed because they were being kept offshore. So I suspect that's one of the reasons they wanted it reported, to give them the information about, you know, how much this relief is costing. And obviously that doesn't give the full picture, because you don't know how many of those people would have moved to the UK had there not been the relief. You don't know how many people would have moved had there been a more generous relief. But it does give them some information, which I think was lacking when they were formulating these policies.
It also emphasises the point that you probably want to ensure that you get fee protection, and when you have your tax return for the relevant years, that you do claim the FIG, because you will be including so much more detail on your return, which they could look into.
Yeah, absolutely. And I think as the tax returns for those outside the 4-year regime, within the 4-year regime, they're going to get more complicated, which means inquiries will be more complicated. So absolutely, that fee protection is going to be really, really valuable.
Yeah.
Brilliant. Wow, thank you. That was a whistle-stop tour through the non-dom changes. I suppose we can't really call it non-dom changes anymore because the non-doms won't exist after April.
Yeah, and they apply to UK DOMs too, but
UK,
we
yeah.
still call them that.
Yeah. So the changes to those coming in and out of the UK.
That's not as snappy as we need a new title, a banner title.
We do. Well, maybe that's thought for next time. But
Yeah.
but no, thank you, Alex and Mike, for joining me today. We work with a wide variety of clients at Saffery's. Many are UK based and many live overseas, but have interests here, whether that's property, business interests or investments. We advise individuals and families on how best to safeguard, maintain and enhance their wealth and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax rules in the UK, which can be complex. If you'd like to find out more about Saffery's and how we can help you, please head over to the Saffery's website at www.saffery.com. However, it's important for me to stress that if you're considering any of the topics discussed today, you must take professional advice based on your individual circumstances. Thank you for listening.